It's truly amazing how a corporate financial report, just a stack of numbers really, can actually tell a really compelling story.
If you know how to read it, yeah?
Exactly, if you know how to read it. And today on the deep dive, our mission is basically to transform R R Kabel Limited's latest results, for the quarter ended June 30, 2025.
Right.
We're pulling insights from their official board meeting outcomes, the detailed limited review reports from BSR & Co., LLP, their corporate presentation, and the company's press release.
Oh, all the key documents.
All the key stuff.
Yeah.
And we want to turn that into genuinely actionable insights for you, revealing not just what happened, but why it truly matters.
Yeah.
And maybe find some surprising facts along the way.
Sounds good. Let's dive in.
Okay, let's unpack this then. The headline numbers from R R Kabel Ltd, they immediately tell us they've had a really strong start to their fiscal year.
Definitely looks that way.
Looking at their year-over-year performance, so Q1 FY26 compared to Q1 FY25, it's pretty impressive. Revenue from operations, it soared to INR 2058.6 crores.
Which is over 20 billion Indian rupees, just for context.
Right, a big number. And that marks a robust 13.9% increase. But here's where it gets, I think, even more interesting. Their profitability growth. Operating EBITDA reached INR 143.1 crores. That's a surge of, get this, 49.9%.
Wow, nearly 50%. That's significant.
It really is. And it's not just the big number, their EBITDA margin, that key measure of operational profitability.
Yeah, how much they make per rupee of revenue, basically.
Exactly. It improved by 167 basis points, so 1.67 percentage points up to 7.0%.
Okay, so a healthier margin.
Definitely. And profit after tax, or PAT, was INR at 89.8 crores, up by 39.4%. The PT margin also saw a nice increase, 80 basis points to 4.4%.
And the EPS.
Ah, yes. Basic earnings per share, consolidated, stood at INR 7.94 compared to INR 5.71 in Q1 last year.
What's truly striking here, I think, isn't just that they grew the top line, the revenue.
Right.
But how significantly they boosted those profitability margins. It really signals much stronger underlying operational efficiency.
So they're running tighter.
Exactly. Think of it this way. Margin expansion means they're not just selling more, but they're actually doing a much better job controlling their costs relative to the revenue they're bringing in.
Okay.
For you, this points to a business that's becoming more resilient, more efficient with every single sale. It indicates a healthy and growing enterprise, really.
That's definitely a great sign.
Yeah.
But, of course, no single quarter exists in a vacuum, right?
True. Context is key.
To fully appreciate this strong start, it's also crucial to look at how they did compared to the previous quarter, Q4 FY25.
The sequential performance.
Yeah. Just to give you some quarter-over-quarter context, looking at those figures, revenue was actually INR 2,217.8 crores. So that's a 7.2% dip sequentially.
Okay.
Operating EBITDA was INR 195.8 crores, down 26.9%, and PAT was INR 129.1 crores, down 30.5% quarter-on-quarter. So strong start compared to last year, definitely, but a sequential dip. What should we make of that? Is that a worry?
Well, it's an important observation, absolutely. And if we place this in the, broader context, while there is indeed a sequential dip, it's vital to remember that financial reporting often has these nuances.
Right.
These can make direct quarter-on-quarter comparisons a bit tricky, especially when you're crossing fiscal years like this.
Okay.
The sources we looked at indicate that those Q4 FY25 figures were actually balancing figures. They were calculated between the audited full previous year results and the reviewed year-to-date figures up to Q3.
Ah, so like an accounting adjustment almost.
Pretty much. And that kind of adjustment can sometimes impact the direct comparability of that specific sequential jump. It's not necessarily a sign of a sudden downturn, but more a characteristic of how these reporting cycles can work sometimes.
Okay, that definitely clears things up. It's not just a simple drop then.
Not necessarily, no.
Right. Now, here's where the real story, I think, unfolds, and it holds a, fascinating surprise. R R Kabel operates primarily in two main business segments.
Wires and cables and FMA.
Exactly. And their performance in Q1 FY26 was quite different for each. It offers a really insightful contrast. Let's start with their powerhouse, the wires and cables, or W&C segment. I mean, this segment really dominates, right? It accounts for a full 89% of their Q1 FY26 revenue mix.
Yeah, the vast majority.
And it saw strong growth, Revenue hit INR 1833.5 crores, showing roughly 16% growth year over year,
Solid growth there.
and its segment profit also improved by about 23% YoY, hitting INR 139.1 crores. So that's a strong, consistent performance from their core business.
Indeed. And this raises an important question, doesn't it? What factors really propelled this robust growth in W&C?
Good question. What did the report say?
Well, they highlight a kind of multifaceted picture. They cite improved demand, particularly in the export market, which is, a testament to their international reach expanding.
Okay, exports helping.
Yeah, also, favorable copper prices played a role. Can't ignore commodity prices in this sector. And better realization, essentially, they were converting sales into cash more effectively. Plus, you have the background factors, continued infrastructure expansion, increased electrification efforts in their markets.
So good market tailwinds.
Exactly. Strong tailwinds, all underscored by what seems like good overall operational efficiency. It looks like a clear case of both, market opportunity and solid internal execution coming together.
So it sounds like for wires and cables, pretty much everything went right in the quarter.
It certainly looks that way from these numbers.
But let's turn our attention now to the other segment, fast-moving electrical goods, or FMA.
Right, the smaller segment.
Much smaller, and you might expect it to follow suit or maybe even continue struggling a bit. But what happened here is really counterintuitive and, frankly, maybe an aha moment for anyone watching the business.
Oh.
Get this. While its revenue remained almost flat, INR 225.1 crores, basically unchanged compared to Q1 last year.
Okay, so no growth there.
No real growth. But the really intriguing detail here is about its profitability. The segment loss was substantially reduced.
Substantially. How much are we talking?
Well, to quantify that, the loss decreased from INR 20.7 crores in Q1 FY25 down to just INR 7.1 crores in Q1 FY26.
Wow. Okay, that is a massive improvement, cutting the loss by almost 2/3.
Exactly. Even with flat revenue. That's the surprising part.
That's right. And what's absolutely fascinating here is that, even with no significant top-line growth, reducing a loss by that much indicates a really razor-sharp focus on cost management and a clear strategic path toward future profitability in that segment. For you, it's a key sign of, serious internal improvements and disciplined execution.
So how do they do it? Cut costs?
Well, the reports attribute this significant reduction in loss primarily to, yes, substantial savings in operational costs. But also, there was a marginal increase in contribution, likely due to a slightly better product mix and maybe some subtle volume growth in profitable areas. It really demonstrates how a company can unlock significant value just by surgically improving its internal efficiency. Even when market conditions don't allow for that dramatic revenue expansion, it's almost a blueprint for turnarounds.
That's a powerful lesson right there, isn't it? Profitability isn't just about sales growth.
Absolutely not. Efficiency matters hugely.
So beyond just the top and bottom lines, the reports also give us a bit of a peek into R Cable's, let's say, operational smarts and strategic moves. Let's talk about something called working capital management. As of June 30th, 2025, their inventory stood at 56 days, debtors at 35 days, and creditors at 52 days.
Okay, the working capital cycle numbers.
Yeah. Now, for listeners who might not be deep into financial statements every day, what do these days figures really tell us about a company's health?
That's a great question because these numbers are actually very, very telling about a company's operational fluidity, its cash flow health. Efficient working capital management is just crucial. It affects liquidity, and ultimately it frees up capital that can then be, redeployed for growth or other strategic things.
So break down those numbers for us. Inventory at 56 days.
Right. Inventory at 56 days. That's roughly how long it takes them on average to sell their stock after acquiring or making it.
Okay. And debtors at 35 days.
Debtors or receivables at 35 days. This is the average time their customers take to pay them for the goods or services they've sold.
Gotcha. And creditors at 52 days.
Creditors or payables at 52 days. This represents how long R R Kabel takes on average to pay its own suppliers.
So looking at those together.
Well, if we connect this to the bigger picture, these figures show a pretty stable, maybe slightly improved position compared to the end of the last fiscal year, March 2025.
Okay.
Specifically, managing their creditors efficiently at 52 days, maybe stretching payments slightly longer, gives them a bit more flexibility in their cash flow, which is always a positive sign for operational agility.
That makes perfect sense. Cash is king, after all.
Always.
Another interesting point for the reports is their revenue mix, looking at domestic versus exports.
Ah, yes, the geographic split.
For Q1 FY26, the mix was 71% domestic and 29% export. This is actually a notable shift from Q1 last year, Q1 FY25, where it was 76% domestic and only 24% export.
So exports are becoming a bigger piece of the pie.
Exactly. It suggests a growing international footprint for R R Cable. Why is that a key strategic move for them, do you think?
Well, diversifying into international markets is it's a classic strategic play, really. It allows our cable to tap into global demand.
Right, not just relying on India.
Precisely. It reduces their reliance on any single domestic market, which can, mitigate risks if one region maybe experiences an economic slowdown.
Spreading the risk.
Exactly. It shows a forward-thinking approach to broadening their customer base and accessing totally new growth avenues. And it's also worth noting here, their consolidated results include the financials of their joint venture.
Don't you have the one in Bangladesh?
That's the one. R Imperial Electricals Limited. It contributed about INR 1.01 crores in net profit after tax for the quarter. So that just further reinforces that international expansion angle.
Got it. Okay. Finally, let's touch on management's vision, because that often gives us a sense of their confidence and strategic direction.
Sure. The commentary is important.
Mr. Mahindra Kumar Kabra, the managing director, he stated they are, quote, pleased to begin FY26 on a strong footing, delivering broad-based growth across key financial and operational parameters.
Sounds confident.
Yeah. And he attributed this success to their sharp execution focus, the resilience of our business model, and the continued trust our customers place in us.
So hitting the key messages: execution, resilience, customer trust.
Pretty much. And it really underscores the company's commitment to quality and innovation, too, mentioning adherence to global guidelines like REACH and RoHS.
Which is important for those export markets especially.
Definitely. So it sounds like a management team that's both pleased with the results, understandably, and pretty clear on their path forward.
Seems that way. A positive outlook.
So wrapping up then, this deep dive, I think, has shown us that R Cable Ltd. delivered a really robust Q1 FY26. It was driven by strong growth in its core wires and cable segment.
Main engine.
And perhaps most surprisingly, that significant turnaround in the profitability of its FMEG segment, even without revenue growth there.
Yeah, that FMEG story is quite something.
It really is. We've walked through the numbers, the strategies, the context, so you can hopefully quickly grasp the core health and the direction of this company based on this quarter.
Hopefully providing some useful insights.
Yeah. And as you reflect on this deep dive, maybe consider this final thought. How might R Cable's success in drastically cutting those losses in its FMA segment, even with flat revenue, how might that serve as a kind of template?
A template for other companies, perhaps.
Exactly. For other companies looking to optimize performance, especially in maybe challenging or more mature markets where just chasing sales growth isn't always the answer.
That's a really interesting question to ponder. How transferable is that focus on internal efficiency? Food for thought.